Paper invoices, missed discounts, and late payments hide massive costs. Wasted labor, avoidable late fees, and escalating fraud risks quietly drain your working capital. Accounts payable automation replaces those physical bottlenecks. By combining optical character recognition, machine learning, and continuous digital workflows, the software extracts supplier, amount, and line-level details instantly. In this tutorial, we will build a pilot program designed to cut your invoice processing costs by up to 80%, shrinking your payment cycle times from days down to a matter of hours. Before we begin, you need two things in place: a highly accurate count of your current invoice volumes and an active enterprise resource planning system ready for integration. For finance teams facing tighter margins, replacing paper with a continuous digital process is a mandatory survival strategy to protect cash flow. Step 1 is establishing your baseline. You must measure your current invoice volume, your average cycle time from receipt to payment, your error rate, and your exact processing cost per invoice. Do not rely on estimates. Poor baseline data is the most common pitfall at this stage. Instead, run a short, time-boxed manual audit to capture verifiable, real-world metrics. This visualization breaks down the return on investment calculation. You subtract the new automated cost from your current manual cost and multiply that difference by your total invoice volume to find your projected annual savings. Step 2 involves prioritizing your specific use cases. You will design this initial pilot program to run for a focused 8 to 16 weeks. To select your pilot vendors, filter out the complicated edge cases. You want to capture high-volume, low-complexity invoices that offer quick wins, like early payment supplier discounts. A major failure point is trying to automate everything at once. You must limit this pilot to a small, controlled subset of vendors or a specific department. By enforcing strict baselines and narrow boundaries, you prevent project bloat and ensure your team secures measurable financial momentum early in the rollout. Step 3 is connecting the digital plumbing. You will integrate the automation platform directly into your main ERP ledger and your banking payment rails. This interface shows the critical process of data field mapping. Properly aligning the fields between the AP software and your ERP database guarantees seamless communication and eliminates all duplicate data entry. Shallow integration causes reconciliation gaps. Finance and IT teams must run end-to-end testing together to verify every connection before moving forward. Step 4 is configuring the digital workflows. Here, you define your exact matching tolerances and approval rules. This flowchart illustrates three-way matching. The system automatically evaluates an incoming invoice against the purchase order and the receiving receipt, instantly flagging any discrepancies. Once matched, the invoice follows automated routing rules, pushing the document to the correct approver based on specific triggers, like total dollar amount, designated cost center, or vendor identity. Do not make these rules overly rigid. Invoice exceptions will happen, and your system must be flexible enough to handle them. Establish an exceptions backlog review process. The software will highlight anomalies and provide the surrounding context, so your AP clerks can resolve the issue quickly. Through these digital rules, the accounts payable department stops operating as a manual data entry factory and becomes a highly efficient, strategic exception handling hub. Step 5 addresses the human element, executing user training and change management for both your internal staff and your external suppliers. You can drastically reduce inquiry volume by deploying self-service vendor portals. Suppliers log in, submit their own invoices, and track their payment statuses without ever sending an email. Internally, cloud-based mobile applications eliminate approval bottlenecks. Remote managers receive a notification and can review and sign off on an invoice instantly from anywhere. Low user adoption will stall the pilot. Provide role-specific quick reference guides and engage your power users early so they can demonstrate the platform's benefits to the rest of the team. Step 6 is the launch. You roll out the pilot into the live environment and activate your real-time reporting tools. This dashboard displays the critical metrics you must monitor from day one. Watch your cost per invoice, your payment cycle time, your percentage of straight-through processing, and your days payable outstanding. You must also establish a monthly review loop. Your team will analyze the exception rate and fine-tune the matching logic to push more invoices through without human intervention. High user adoption paired with real-time data visibility creates a self-correcting system. As the rules improve, the platform continuously optimizes your working capital. With the pilot live, the foundational work is complete. Your ledger data remains strictly accurate, and your suppliers now receive reliable, predictable payments. This visibility yields immediate secondary advantages. You gain automated approval thresholds that drastically reduce fraud risk, and the flexible payment timing allows you to negotiate dynamic discounting with your vendors. You also achieve critical environmental goals. Entirely eliminating physical paper and courier shipping cuts your carbon impact and streamlines your corporate ESG reporting. From here, your post-pilot roadmap is straightforward. You will monitor the key performance indicators, gradually scale the automation logic to include more complex vendor tiers, and expand across new geographies. By completing this pilot, you transition the Accounts Payable department from a simple cost center into a strategic financial function. To build a custom ROI model and implementation plan for your organization, schedule a free consultation using the link provided.